In today's video, we have a lot to discuss. Walmart and Trump got into a bit of drama over tariffs and inflation. Bond yields have been spiking, which caused the S&P to fall yesterday. Dalio has also been telling investors to watch the bond market. And then I want to quickly discuss Uber stock and a new stock that Bill Ackman has been buying. Before we get into today's video, I'm excited to let you know that this video is sponsored by Hamilton ETFs. Hamilton is one of Canada's fastest growing ETF providers, with over $7 billion in assets under management now. They recently launched their new Mixed Asset ETF with the ticker symbol MIX. This is an all-in-one ETF that has 60% exposure to US stocks, 20% to US treasuries, and 20% to gold. Hamilton has also enhanced this ETF with a modest 25% leverage to increase growth potential. The MIX ETF tracks the selective Hamilton Mixed Asset Index, but again, has 25% leverage to enhance the returns. Historically, the Mixed Asset Index has roughly matched the S&P 500's returns, but when we factor in the modest leverage, it has outperformed, producing a 12.4% compounded annual growth rate since 2004 versus the S&P's 10%. What's also interesting is the Mixed Asset Index has produced this outperformance with less volatility and lower drawdowns, even with the leverage. The max drawdown has been 32.9% versus the S&P's 55.3%. Additionally, during the 10 largest drawdowns over the past 50 years, the 60-20-20 portfolio had an average drawdown of 15% versus the S&P's 30.8%. So it's consistently experienced less downside volatility. Hamilton created this ETF with its objective to be a low-cost, long-term, diversified buy and hold ETF. They're also waiving the management fee until April 30th, 2026. So if you're interested in checking out this ETF and learning more about it, then click the link in my description or head to hamiltonetfs.com. And thank you again to Hamilton for sponsoring today's video. All right, now with that being said, let's hop into the Walmart and Trump tariff news. So this first screenshot comes from Walmart's Q1 2025 transcript, and I have a few more that we're going to cover as well. But this first one says, "We will do our best to keep our prices as low as possible. But given the magnitude of the tariffs, even at reduced levels announced last week, we aren't able to absorb all of the pressure given the reality of narrow retail margins." So right away, Walmart is saying that the tariffs are causing their costs to go up, and they're not able to fully absorb all of these costs, which basically means that they're going to have to pass those costs on to consumers through raising prices. Now, moving on to the second screenshot, this one says, "The merchandise that we import comes from all over the world, from dozens of countries. Other than the US, the other large markets are China, Mexico, Vietnam, India, and Canada. China in particular represents a lot of volume in certain categories like electronics and toys. All of the tariffs create cost pressures for us, but the larger tariffs on China have the biggest impact. The cost pressure from all the tariff impacted markets started in late April and accelerated in May. We won't let tariff related cost pressure on some general merchandise items put pressure on food prices. But as it relates to food, tariffs on countries like Costa Rica, Peru, and Colombia are pressuring imported items like bananas, avocados, coffee, and roses. We'll do our best to control what we can control in order to keep food prices as low as possible. We're positioned to manage the cost pressures from tariffs as well or better than anyone, but even at the reduced levels, the higher tariffs will result in higher prices." So there's a few interesting things that Walmart has said in their Q1 transcript. The first thing that really stood out to me is that in April, which is actually in the second quarter, is when they started to see increased cost pressures from tariffs. And then they said that the cost pressures accelerated in the month of May. We're going to discuss why this is a little bit later on in the video, but they're basically saying that in the second quarter is when we're going to start to actually see the tariffs impacting margins overall. And I think that this is going to be the case for a lot of companies that are going to report their second quarter earnings in a few months. So I don't think that we have yet seen the full impact of tariffs on businesses' financials, but I think that we will start to see it in the second quarter and especially heading into the third quarter. Because as Walmart said, the tariff costs accelerated into May. Now, the second thing that they are saying that really stood out to me is very simply that they cannot absorb all of these costs. and they're now going to have to start raising prices to pass the increased costs onto consumers. Now, when Trump caught wind of this, he went over to Truth Social and he posted that Walmart needs to be eating the tariff costs after they reported their first quarter report. And this is Trump's Truth Social post from May 17th, where he said, Walmart should stop trying to blame tariffs as the reason for raising prices throughout the chain. Walmart made billions of dollars last year, far more than expected. Between Walmart and China, they should, as I said, eat the tariffs and not charge valued customers anything. I'll be watching, and so will your customers. Now, to me, this kind of sounds like Trump is putting out a little bit of a threat to Walmart and trying to set an example for any company that wants to try and offset the increased costs from tariffs and pass those costs on to consumers. Now, I also try not to be political at all on my channel, but in general, with every politician, I agree with some things that they do, and I disagree with other things that they do. I'm not saying I'm pro or against Trump or anything like that. I'm just trying to say that in this one instance, I think that he's being a little bit ridiculous and just straight up wrong. He's basically saying that, hey, my tariffs are not actually going to increase your prices, and Walmart is increasing their prices and using tariffs as an excuse to make more money. Walmart's profit margins are incredibly thin, just like any other retailer. So if their input costs from China go up 100% or even 50%, then that is going to significantly impact the company's bottom line and potentially cause them to start losing money. So retailers specifically do not have a wide profit margin to soak up all of the increased costs from tariffs, which means that retailers have to pass that cost on to their consumer through increasing prices to maintain their profit margins. They simply don't have a wide profit margin for costs to increase rapidly. I mean, if we go and take a look at Walmart's net margin, it's only 2.75%, basically 2.8%. This is a razor thin profit margin. So they're going to have to increase prices if their costs are also going up. And I don't think that this is Walmart trying to be political. I think this is more so Trump just trying to maintain the narrative that tariffs are not paid by the US consumer, which I'm pretty sure most people know by now, this is false. If tariffs are in place and costs go up for the business, they have to put that cost on the consumer to maintain profit margins, especially on businesses with low profit margins like retailers and like Walmart. So I think that this is a little bit ridiculous personally. And I think that it's very clear, and it's always been very clear, that tariffs have to be passed on to the consumer because not all businesses can eat these costs. They simply cannot. They do not have the profit margins. After Trump put out that Truth Social post, Walmart's CFO also responded saying, "We have always worked to keep our prices as low as possible, and we won't stop. We'll keep prices as low as we can for as long as we can, given the reality of small retail margins. We're wired for everyday low prices, but the magnitude of these increases is more than any retailer can absorb. It's more than any supplier can absorb. And so I'm concerned that consumers are going to have to start seeing higher prices. You'll begin to see that likely towards the tail end of the month and certainly much more in June." So what the CFO is saying here is that prices are going to start increasing and they're going to start increasing more in June. Now, another thing that I find interesting about this is I do agree that Walmart is probably more well equipped than many retailers across North America to handle increased costs and overall inflation to their bottom line. So you have to think about this. If Walmart is going to be struggling with the increased costs from tariffs and they're going to have to pass that cost on to consumers, then think about other companies that may not be nearly as well equipped as Walmart. What are they going to have to do? And the answer is pretty clear to me. Across the board, retailers are probably going to have to increase their prices quite dramatically. On May 16th, it also was announced that consumer sentiment is falling and inflation expectations are rising. In this article, it says the outlook for price changes also moved in the wrong direction. Year-ahead inflation expectations rose to 7.3% from 6.5% last month, while long-term inflation expectations ticked up to 4.6% from 4.4%. So expectations are that inflation will spike dramatically over the next year, and this is mostly due to tariffs. And it seems like the expectation is that this will be a quick spike and then it will start to come down. But 7.3% inflation over the next year is a pretty freaking high number. Inflation is currently coming down, though, but this is because the tariffs haven't worked their way fully through the economy yet. As Walmart said, they had to start raising their prices in May, and it's starting to accelerate into June. Apollo, which is one of the largest private equity companies, does these economic presentations, and in one of their recent presentations, they showed that it'll be late May into early June before the retailers really start feeling the tariff impacts on Chinese goods and all of their imports. This is because it takes time for new inventory to get to their shelves. And in the meantime, retailers are still selling all of their previous non-tariffed inventory and goods. Apollo is basically saying that we will start to see more inflation from tariffs in June. That's their expectation, and this is also in line with what we just read from Walmart's CEO and CFO. Now, the increased inflation expectations are partly why bond yields started spiking again yesterday, which caused the S&P 500 to drop rapidly midway through the day. The other factor was that Trump's big beautiful bill passed, which had a significant amount of tax cuts and changes within it. For example, the bill removed many renewable energy tax incentives that renewable energy companies were benefiting from, like a tax credit of up to 30% for the cost of installing solar, wind, geothermal, and other renewable energy systems. Many solar stocks like Enphase are tanking today on this news after the bill was passed. This bill also included a lot of other tax cuts, like the permanent individual and corporate tax cuts that Trump initially announced in 2017 in the Jobs Act. Overall, these tax cuts are expected to add $5 trillion to $7 trillion to the deficit over the next decade. Basically, this bill removed a lot of revenue from the federal government, which analysts are saying will increase the US's overall debt levels as they now have less revenue coming in. This chart also shows us that the US has been spending more money so far in 2025 than in 2024. So even despite the efforts of Elon Musk and Doge, the US is still spending more money this year. So the US is currently on track to spend more money year over year, and this new bill that was just passed is expected to have less net revenues for the overall government. This combination of higher government spending and less government revenue increased US deficit projections. And when you add all of this to the increased inflation expectations, this is all what caused bond yields to spike. For those of you who may not understand government bonds and how yields work, when yields are rising, it means that the demand for government bonds is actually going down. Because when the price of a bond goes down, just like with a stock, when the price of a stock goes down, the yield on the stock goes up. And when prices are going down, it means that there's less demand for bonds. So the reason that government bonds and bond yields were spiking yesterday is because there is less demand for US government debt, or just US debt in general. This is kind of a problem because the US debt load is massive, it's continuing to grow, and it seems like it is continuing to grow at a faster and faster rate with all of the increased government spending. So basically, global investors are not wanting to buy as much US debt, and this is causing the bond yields to rise, and it's also saying that investors want a higher return on government debt from the United States because it is appearing more risky, because the debt levels are growing, because inflation expectations are growing, and because overall government spending doesn't really seem to be slowing down. So overall, it just seems like investors are less bullish on the overall US economy right now with everything that is currently going on, all the trade wars, all the tariffs, all the uncertainty, etc., etc. Now, additionally, what happens when bond yields rise is stock prices and every other asset price falls. And this is because the US government bond is considered the risk-free rate because you're going to get paid your return unless the US government defaults on its debt, which they're probably not going to do, especially when they are the reserve currency in the world. So when bond yields are rising, investors can get a higher risk-free return on their money. The example that I like to use on my channel is imagine if US bonds were offering 20% today. If they were, I would probably sell my entire stock portfolio and go and buy government bonds because I could get a guaranteed risk-free 20% annual return for the next 10 years, and I could just go sit on a beach and not worry about anything. So as bond yields rise, they start to look more and more attractive versus the stock market and versus every other form of asset. Because again, you can get a higher risk-free return. And this is a weighing scale that is constantly moving. So when bond yields rise, stock prices fall because more money is leaving the stock market and going into the bond market. They have a direct relationship with each other that I actually wrote about at length in my book, The Fundamentals of Investing. So if you want to learn more about this relationship and how bond yields set the fair value for every single asset, I would recommend going and buying my book and checking out that chapter. But this is what happens. So when bond yields spike, the stock market falls and stock valuations also fall. And the more rapidly that bond yields spike, the more rapidly that stocks fall. That's why when bond yields spiked rapidly yesterday, the S&P 500 also fell rapidly, because the risk reward of stocks was just not looking nearly as attractive versus bonds. Now, Ray Dalio also put out a very quick video on X where he talked about US government bonds and how investors should be watching bond yields. So I'm going to play that clip really quickly, and then we'll discuss it quickly afterwards as well.
Watch the bond market. The bond market is the basis, it's the backbone of all markets. It is the risk-free, meaning default-free, probably default-free, interest rate that determines what all asset returns are going to be. And when there is a breakdown of the supply-demand picture for the bond market, you see a certain type of market action. You see long rates rising relative to short rates. You see the currency go down. You see gold go up because there's a movement out of that bond market because there's a supply and demand imbalance. When that happens, that raises interest rates, and it puts the Federal Reserve and other central banks in a bind. That supply-demand imbalance, in order to deal with that, when there's not enough demand, they're torn between allowing interest rates to rise and have the negative effect that that has on markets and the economy, or coming in and printing money, essentially, and buying bonds in order to provide the demand for those bonds that aren't there, and that produces inflationary pressures.
In this clip, Ray Dalio tells investors that they should be watching the bond market because if bond yields start to rise, then it is suggesting that there's less demand for US debt and investors are more bearish on the US economy as a whole. Now, Ray Dalio is someone who has been bearish for a very long time. And, honestly, I've kind of just disregarded what he's been saying, and I still am in my own portfolio. I'm not hoarding cash or anything like that. I'm still buying stocks. I'm still investing actively. So, yeah, with all this information, I'm still trying to think long term and just not get so caught up in the macro and day-to-day stuff like this. But it is still interesting to know what's going on and follow all of this news. But what Ray Dalio is saying here is that the Fed is in a little bit of a pickle, because historically, what the Fed could do is when bond yields are going up, they could just print money and create liquidity. So they could literally just print money and go and buy bonds to create liquidity to keep bond yields down. They essentially create demand for bonds, which again causes bond yields to go down. However, when the Fed prints money to do this, as we learned from COVID, it causes a lot of inflation. So if the Fed wants to go and save the bond market to try and get bond yields to come down, then that would ultimately cause inflation. And that is not what the Fed wants. Their number one goal right now is to keep inflation low and have it continue to trend down. Now, on top of this, as we saw earlier on in the video, inflation expectations are going up due to Trump's tariffs. So inflation expectations are up to 7% over the next year. So the Fed is looking at these expectations. They're looking at the data, they're looking at the tariffs, they're looking at bond yields rise, and they kind of can't do anything about it this time. Because if they do something about it, then they're going to cause inflation to spike even harder when inflation expectations are already rising. So Ray Dalio is essentially saying that, hey, this time we may not be saved by the Fed. If there's an actual economic crisis, we may actually be hooped this time. Bond yields may spike, asset values may drop a lot, and that's just kind of the reality of the situation we're in, because we have a slowing economy, we have higher inflation expectations, and bond yields are also rising. And this is in a situation where the Fed can't really do anything. So the next recession that we see, if there is a recession, all of these super investors that I've listened to are basically just saying that we may not get bailed out this time. And Personally, I think that this could actually be awesome for long-term investors, okay? I'm getting kind of tired of every time the market goes down 15% or every time it looks like a recession may come, we just get economic stimulus and things go right back up to normal and asset prices stay high. For long-term investors, it would actually be in our best interest, the young people who are continuing to buy stocks, it would be in our best interest if we could actually get a period where asset prices go down and they stay down for a few years. That would give us the opportunity to buy into stocks at higher future returns. And I know that people in the short term, they don't want to see their portfolios go down. It's uncomfortable. I get that. But if you are a net buyer of stocks, then you actually want stock prices as low as possible. And for me, as someone who is a net buyer of stocks and I have decades of investing left in front of me, I want the market to have a period where it truly goes down and we truly get some attractive prices, because we've been in this freaking expensive market for like 5 years now, where PE ratios and everything across the board in the S&P 500 is just ridiculous. There is value in the markets. I'm someone who believes that there's always value in the markets, especially when you're an individual stock picker. But as a whole, the S&P is it's just not really that attractive in my opinion. So I've had to continue looking elsewhere. So personally, I do kind of hope that if we get a recession, then the Fed won't bail us out right away, and they'll allow, young investors who can continue to buy stocks, they'll give us the opportunity to actually buy some freaking stocks at cheaper prices. Now, moving on to the next screenshot, this one comes from Apollo once again, and it says the risk premium for holding stocks, the difference between the S&P 500 earnings yield minus the 10-year treasury yield, is currently negative. In other words, investors are paying to take a risk opposed to being paid to do so. This chart shows what Apollo is talking about, and this dark blue line right here that the arrow is pointing to is the S&P 500's risk premium. And we can see that it went negative for the first time near the end of 2023 and into 2024, and now we are definitely still in the negative territory. Now, what the S&P 500's risk premium is just the difference between its earnings yield and the government bond yield. This is what I went back to earlier. What investors do is they compare the different risk and returns of different assets. So when bond yields are yielding 4.5% to 5%, typically investors would want the earnings yield of the S&P 500 to be above that, because if the risk-free rate is 4.5%, then you want a higher return if you're going to be buying a more risky asset like a stock. However, this is not the case in the stock market right now. The risk-free return is actually higher than the return on riskier assets like stocks. And overall, this is suggesting that the S&P 500 is expensive right now, and investors are actually paying more to take more risk, which when you think about it, doesn't really make a lot of sense. And this is partly why I have been saying for quite some time now that I think the S&P 500 as a whole is looking expensive, and I'm not really too interested in owning the indexes right now. JP Morgan's Guide to the Market from April 30th, 2025 also shows us that when the S&P 500 has historically been this expensive, the future returns over the next 5 years have been about 5% on an annualized basis. We can also clearly see that as the price to earnings ratio of the market goes up, the returns of the market tend to go down. There's a very clear correlation between the price you pay for an asset and the future returns that you can expect from that asset. And right now, the future returns that we can expect from the S&P 500 over the next 5 years or over the medium term is not very high. It's single digits at best. And this is what I mean. This is why I'm not interested in the S&P 500 right now, because based on all of the historical context and all of the historical data, it looks expensive and the future returns of the S&P are probably going to be lower. So in my opinion, I think that we're in a period where people who can pick high quality individual stocks and know how to find attractive businesses at attractive prices will outperform the overall index going forward over the medium term and over the next 5 or so years. I've been saying that for a little bit on my channel as well, and I am happy to say that I am someone who has been consistently outperforming the S&P 500. My Patreon community gets access to my portfolio, all of my buys and sells, every stock that I hold, and monthly portfolio updates where I track my performance versus the S&P. And my returns have been about double the S&P 500's quite consistently. And I think that while the overall S&P 500 is expensive and we're in this type of market, this is only going to continue because I am able to find what I believe are high quality businesses selling for cheaper prices that are also experiencing more growth than the overall S&P. And that combination should lead to overall continued outperformance. Now, on the note of picking individual stocks, I have been asked a lot about Uber recently because they did just crush their most recent earnings report, and in my opinion, this is not a stock that is looking very expensive in the market today. However, not that long ago, Uber was selling for about $60 per share, and it is currently up around 46% from its lows that it had near the end of 2024. However, with that being said, Uber still had a pretty dang strong earnings report, so I want to go through some of the highlights that I found. And here this says, we kicked off the year with yet another quarter of profitable growth at scale, with trips up 18% and even stronger user retention. We delivered over $2 billion in quarterly cash flow, with multiple levers in our control to generate industry-leading cash flow growth. Trips during the quarter grew 18% year over year, gross bookings grew 14%, revenue grew 14%, net cash provided by operating activities was $2.3 billion, and free cash flow was also $2.3 billion. Then in the outlook for the second quarter, they're saying they're expecting gross bookings to grow 16% once again year over year, which ultimately means that revenue will probably grow by roughly 16% in the second quarter as well. So at face value, this looks like it was a fantastic earnings report from Uber. They're growing their revenues and their cash flows by double digits, even into what seems to be a weaker overall economy. Now, moving on to their cash flow statement, we can see that stock-based compensation came in at $435 million, which is actually down year over year. So Uber's stock-based compensation is declining at the same time as the fundamentals of the business are growing, which is something that I like to see. Operating cash flows came in at $2.3 billion, and capex for the business came in at only $74 million. So they generated about $2.25 billion in free cash flow. And what I like about Uber is they are growing their operating cash flows massively. I mean, it grew by $900 million year over year, but their capex only grew by $17 million. So they produced another $900 million of profits from their business, while capex only grew by $17 million. So this business seems like it has a lot of operating leverage, and as the operating cash flows continue to grow, I am expecting this business to continue producing a significant amount more in free cash flow. In Uber's 2024 investor presentation, they also gave a 3-year outlook, and they said that they are expecting gross bookings to grow in the mid to high teens, adjusted EBITDA to grow 30 to 40% annually, and free cash flow to be about 90% of adjusted EBITDA. So Uber was expecting its revenue to grow mid to high teens and its free cash flow to grow between 30 to 40% annually. And so far, again, this was in 2024, and so far they are actually meeting these goals and hitting their targets. Now, if we go over to Uber, even though the stock is up 46% from its lows, it's still trading for a price to free cash flow of about 24. And in my opinion, this is not a very high multiple to pay for a business that is able to grow the top line around 18% annually, and they're projected to grow their free cash flow by 30 to 40% over the next 3 years. I try to boil my investing down to what is the multiple I'm paying versus the growth expectations for the business. And with Uber, it's a 24 multiple today, and they're expecting around 30 to 40% annual free cash flow growth. And that combination makes it seem like if Uber can actually hit their targets, then the stock is not looking very expensive today. Again, even after a 40% run to the share price. Now, for me personally, I am not looking to buy Uber because, well, I kind of feel like I maybe missed this one in the dip, but I also am not putting myself down too much because I was aggressively buying stocks that I have higher conviction on. And I think the moral here is that I just don't really have the conviction on Uber's business, and I don't know for certain if they're going to be able to meet their projections. I don't know the competitors, and I just don't really know this market that much. So for me, I also have to have the conviction in the business. But when I'm taking a look just at the metrics, Uber does not look that expensive today, and it definitely could still be looking like an interesting stock in the market. Uber is also a stock that Bill Ackman has been buying recently, and another stock that Bill Ackman just announced that he is buying is Amazon. Amazon is one of the stocks that I was buying aggressively, adding to in my portfolio over the past few months. I mean, the stock got all the way down to $167. And I thought that the sell-off from February of 2025 down to the bottom here of 31% was a little bit ridiculous. I still think that Amazon stock today is arguably looking cheap. So when the stock was down, I was also adding to my position aggressively. And it came out today that Bill Ackman started a position in Amazon during this time as well, and he has officially added it to his portfolio. I think that Amazon is still looking cheap today. It is a stock that I have continued to add, and I'll probably continue to dollar cost average it, so long as the price does not get very insane. Now, Bill Ackman is someone, though, who is always invested in the market. He's usually fully invested. So he had to sell something to buy Amazon. And the stock that he sold was CP Rail. He's owned CP Rail for a very long time. He's been in and out of this one a few times though. But I actually do agree with the sale. And I think that Amazon stock will produce significantly more returns than CP Rail over time. This stock has actually been flat for a few years now. And let's go and take a quick look at its financials. Let's go take a quick look at its revenue. So CP Rail's revenue is at an all-time high. In the most recent quarters, it hasn't really been growing that much. But the revenue shot up massively right here because they did an acquisition. If we take a look at a quarterly basis, we can see that the revenue shot up rapidly, but now it's been kind of flat over the past few quarters. And once again, this is because they did an acquisition and now the revenue is kind of more reflecting the actual business's growth rates. Now, what's also interesting is CP did a lot of dilution to afford this acquisition. The share count grew by roughly 30%. Now, what this means is that on a revenue per share basis, the company is not growing nearly as quickly. We can see that it is at an all-time high, but it's not nearly as impressive as the overall revenue growth for the business. Now, if we also take a look at CP's price to operating income, which is one of the most consistent metrics for this business, we can see that it is trading for about 20 right now, and its long-term historical average has been about 18.4. So CP is trading above its historical average price multiples right now, and its revenue growth rates are very unimpressive in my opinion. And I just think that the price multiple for growth, which again, I try to boil my investing down to the price multiple I'm paying versus the growth rates that the business is seeing. And with CP, the price multiple is very high for the level of growth that the business is seeing. For example, if we go and take a quick look here at their PE, the PE is 28, and this business is growing its revenues by something like 5%. So a 28 multiple for roughly 5 to 10% growth is extremely high. I mean, go and compare that to Uber. They were trading for a lower multiple and they're projecting to grow profits 30 to 40%. So I think that CP stock is looking expensive. I think that Amazon is going to produce more returns. And I do agree with this shift that Bill Ackman did in his portfolio. And he's actually getting more exposed to tech. And I think that Bill Ackman's overall portfolio is going to produce higher returns now. With that being said, I do think that CP is a fantastic business. They have an absolute moat. They're probably one of the strongest moat businesses that I know of. It's just the price versus growth is very extended. And even though it's a high quality business, it's got a strong moat, that doesn't necessarily mean that it has to produce strong shareholder returns in terms of its stock price. And for me, I just don't see it. I don't think that it's going to produce high returns. I actually sold my CP position quite a while ago and moved it into other higher return investments in my own portfolio. And it looks like Bill Ackman is now doing the same thing. So those are the recent moves with Bill Ackman as well. And with all that being said, that's going to wrap up the video for today. If you did enjoy the video, then please remember to leave a like on it. And if you're new here and you want to stick around and see more content, then consider subscribing to my channel as well. But with all that being said, thank you all so much for tuning in today. I truly do appreciate it. And I hope to see you all again in my next video.